Hello and welcome to this week's webinar. If you're watching the recorded version, it was held live on Wednesday, the 11th of October at 12:30 in the afternoon. So this is a webinar we do every week on a Wednesday lunchtime, and it's two parts to it. First of all, there's a market outlook bit, so that's where we take a look at recent trends in some of the major FX pairs, commodities, gold and oil, and also the stock market indices. So we'll do a bit of that, but we also do a bit of education and strategy stuff. So today we'll do a bit on candlestick charting. I think some reversal patterns that can suggest that maybe the trend is coming to an end. It's been an interesting week so far. I think last week we had, I think the pound US dollar had its worst week this year, this calendar year. So it really was, it's been a pretty relentless sell-off. And we saw the euro dollar under some weakness as well, but we've seen some of that turned around this week. I mean, later on tonight, is it 7 o'clock UK time? We've got the Federal Reserve minutes. I think the minutes from the last Fed meeting, I think later on this evening. So that can often inject a fair bit of volatility in the markets, but it also means we could probably have something of a quiet afternoon in Europe ahead of that. But let's take a look. Let's kick off and have a look on the platform. So this is Trade Hub. This is Aondo's trading platform. So Aondo, I think, may be better known for social trading, for copy trading, but you can also do your own self-directed trading as well. So this is the platform we're using. And I thought we'd start off with euro dollar, and then we'll have a look at the pound against the dollar, because we have seen in euro dollar, you know, quite a half decent sell-off, I think, over the last sort of 5 weeks or so. We've come from the 121 area and traded as low, briefly below 117. But we have seen something over the last couple of days, at least, you know, something of a turnaround in the euro's fortunes. And I think it is an interesting one because we have seen such a big rally in euro dollar this year. You know, from the April levels around about 106 up to 121, so a 15% rally in under 6 months for euro dollar. And as usual, the question is, you know, given the weakness that we've seen, is that trend over? And even though, if you look at the trend line's broken, I think, as I've been saying the last couple of weeks or so, you know, it doesn't necessarily mean that trend has come to an end. We haven't taken out any of the previous major lows in euro dollar. So for example, just before the market sort of legged its way up to the 121 mark, you know, 116.60 was a low, and then a little bit before that, that was the low there, 116. So this whole, I think, 116 to 116.50 area has proved to be, yet again, a good level of support for euro dollar. So I think it's interesting down here. It's interesting this level had held. So for me, if I was a betting man, you know, my money would be on to over the next, I don't know, the next month or so, next couple of months maybe, towards the end of the year, on the euro dollar having another go at the 121 highs. And I think for me that view remains valid, assuming these levels hold. I think if we do lose 116, if the market does slip below 116, then it does start to look as if this trend is rolling over. You know, but for me at the moment, any weakness back to here looks like a buying opportunity. For those of you who are fans of the old squiggles at the bottom, you could argue we're getting a bit of a buy signal on the MACDs. Not quite, I think. I think we need to see maybe the end of today. Yeah, it depends how it closes today. You can see on the histogram here. Let me bring that up. So long-term viewers of the webinar now, I'm not a massive fan of oscillators, but I know some people are. You can see as of today that the histogram thing has flipped over the zero line, suggesting the MACDs have crossed. We'd need to wait, I presume, for the close today for that to be valid. But we haven't really had a buy signal on this side of the middle line since April last year, when that big trend started. So I think it's interesting, you know. So I mean, one trade would be, you know, stops the other side of these lows, wide stops. But if we think this trend is going to leg higher, That's one level. But I think it's interesting the MACDs are crossing over. Let's have a quick look on the hourlies. I do have a couple of trades going on euro dollar at the moment, so I've been paying a bit of attention for a change. You can see how the market has come up. You know, we have rallied pretty hard off the lows from what, the 6th of October. So from last Friday, we had the payrolls on Friday, didn't we? The payrolls came out. The market was expecting 80,000 jobs to be added. We ended up with a loss of 33,000 jobs down to those hurricanes in the US last month. So that, I think, has distorted the figure. But so a bit of volatility over it, but we have seen a recovery for the euro. So I think for the short-term traders, you know, I think we've got an obvious level to watch. I mean, going into tonight, these Fed minutes, it could all get a bit choppy anyway. But I think we have 118.30, is it? Something like that. So 118.33. The highs from end of September for the market pushed a lot lower. We have had a look through it this morning, and it's come back. I think if we can see, let's round it up and say if we see like a move through 118.50, I think it does suggest that maybe we're going to see the start of a much deeper recovery, maybe up above the 119s. But you know, in the moment, if you looked at it over the last week, it's a trend that is still is up from these lows. So hang on, let me draw that properly. So we're if I took it off maybe, I don't know, maybe here is a better trend line, I don't know, something like that. So we have pockets of support from earlier on this morning, just below 118. Late yesterday afternoon, 5, 6 o'clock, 118. So this 118 area, I think, for the short-term traders is an important one. But for me, the bigger picture, you know, it does look like maybe this correction's over and we're going to maybe faff around a bit, but look for a run back up to 121. So I think euro dollar is an interesting one. Let's take a look at pound against the dollar. So like I say, pound against the dollar last week, and its worst week this year. So we saw highs in September, trading as high as about 136.50, and you know, during last week it had traded back down to sort of 130.25 levels. So that's, you know, it's a sizable sell-off. We've seen a 600-point drop in a couple of weeks. You know, just I think just a pretty bearish sentiment, pretty relentless sentiment. But you know, going back to that big picture view, the recovery, I think, for pound US dollar this year is still, I think, very much intact. I suppose if we were to pick up on that trend there, it's going to look something like that. Okay, so however we draw it, I think we've got this recovery still intact. So the bounce back of the last few days has been a good one. For the fans of the squiggles, we're not quite gearing up for a buy signal just yet, but the MACDs are getting a little bit closer together. And I think it's maybe a harder one to call this than euro dollar because it has been so weak. If we flip over to an hourly, I think 133 was a bit of a level. Let's have a look on the hourly. So there's we'd had almost like this textbook downtrend on the hourlies from those highs at the end of September, pound US dollar. So we have just started to make the first inroads through that. But for me, the big level is really one of the big levels. The highs back here, I think, are at 133, just ahead of 133. So I think it's interesting. I think, you know, it wouldn't surprise me if maybe we, after such a sharp bounce back from the pound, if we did see it maybe move back into the 131s, and maybe the test then will be, if we see it drift off and buyers come back in, maybe that looks like the better trades, because you can have your stop the other side of that sort of 130.25 level. So maybe we're due a bit of unwinding here, and then the market has to go. But I think we really need to break this 133 level to start looking, you know, start talking about the ability to get back up to the sort of the 136s plus that sort of area. So it's interesting, but the bigger picture doesn't change. You know, the bigger picture, I think, for this year is still valid despite the big sell-off over the last few weeks. That the pound US dollar is still very much in a recovery mode. Let's have a quick look at euro sterling. Then we'll get into the strategy bits. So. Quick look at that. I've not looked at that for a while, but let's have a look. Is that a daily chart? Yes, it is. So euro sterling. Actually, let's take it a bit further out because you know, parity with the pound is clearly, you know, we get lots of headlines if €1 is worth £1. But it's such big barriers. And like we looked at in the past, these are the really long-term charts going back to, you know, the financial crisis days, and we saw the euro, you know, push up to 98. Then it had another go, sort of 95, but it couldn't do it. So I think it's a massive barrier up at these levels. You know, in the short term, we could well see another squeeze back up. Let's flip over to the dailies, but we shouldn't underestimate, I think, maybe just how much resistance there is in the market when we start creeping up to that sort of 95 to 98 level for euro sterling. Saying all that, yeah, the sell-off we'd seen, so it punched as high in August, punched out to 93 in August, sold off, and you can see what great support those early June lows have been ahead of 87. Yeah, the market drifts off, or sells off quite sharply, has a little bounce, drifts off a little bit, but has pushed higher. We get the MACD crossover for the fans and squiggles. So 87, big level of support for euro sterling. So maybe in the short term, we'll see another go up at these levels, because euro dollar does look stronger than pound dollar at the moment. So that would suggest we could see a bit of a squeeze higher in euro sterling. But don't underestimate just how strong those barriers are up there. Okay, let's have a little digression. What's happened there? And we'll talk about the candlesticks. That's what we're going to talk about. So as usual, I'm going to do my my artistic bit. So I've got to flip the screens around and then bring up. Is that working? Is that working? Yeah. Hold on. Right, here we go. Right, candlestick charts. Candlestick charts date back to, I think it's the 1600s in Japan. And Japanese rice traders would sit there after they traded the price of rice backwards and forwards and draw a candlestick chart of where rice traded on the day. And the way it gets shown, it's pretty straightforward. And if you're familiar with a bar chart looks something like that. So we have, if this is a daily bar, we have the open, where the market opened, high traded for the day, the low traded for the day, and the close. And of course, if it's a 10-minute chart, we'd have open, high, low, close for the last 10 minutes. All a candlestick does, it uses exactly the same data, but with candlestick charting, the difference between the open and the close is what's considered important. So that ends up getting blocked in. So our candlestick chart might look something like that. There we go. So it's these bits that are important. It's like the real body of the candle. Traditionally, if the close, as in this example, is lower than the open, our candlestick gets colored in black. And if we have a situation where the close is higher than the open, our candlestick gets colored in white. But of course, you know, with software, you can make it whatever sort of pretty colors that you want. So in candlestick charting, there's a whole sort of area of technical analysis and charting all on its own. So let's just look at some simple patterns. First of all, let's look at the idea of engulfing patterns. So a market is trending higher like that, pushes out to a high, and then we get a candlestick chart, a candlestick that looks something like this. So we have a day where the market opens higher, so it looks like the trend is continuing. But during the course of the day, the market reverses and closes down there. Okay, so this can be a suggestion that maybe this trend here is starting to run out of steam. So this is known as bearish engulfing for obvious reasons, because it's a bearish sign. Let's say the market sells off, and then we get a day that looks something like that. So a white candle where the market opens down here but closes higher by the end of the day. Then that is known as bullish engulfing. And I'd suggest that maybe, you know, the aggressive way of trading these, if you believe the pattern's going to work, and I think they're reasonably. We'll have a look at some real examples in a minute. I think they're, you know, reasonably reliable. Would be a buy on the next day here, for example, with a stop under the previous day's low, because by definition, if that low gets taken out, you know, the engulfing pattern has failed. So you know, it can, if you're trying to catch swings in a trend over days, I think it can be an effective way of flagging up the potential for a trend change. A slight variation on this is where we have that, and then we have a candle that doesn't engulf the previous days. So that is called, but that's still a bearish sign. It's clearly not as bearish as a full engulfing candle, but that is referred to as dark cloud cover. Okay, that's what that is. And then if a market sells off, and then we have a day that pushes higher, pushes through at least 50% of the previous day, but again doesn't engulf the candle, that is called a piercing pattern. Okay, so again, it's a suggestion not as strong as bullish engulfing, but a suggestion that maybe the trend is coming to an end. Right, that's the theory. Let's have a look in the real world, because the real world is never not really Tony Hart. No. It's much easier having computers to draw it all for you. Let's take a look. Let's take a look and see what we can spot. Let's see if we can see anything. Okay, here's an example. What market is this? This is Euro Sterling. Okay, so here is an example going back to July. Let me zoom it right in so you can see it here. So this is, so you see, it's not a brilliant example because it wasn't the greatest trend, but we had a week of the market nudging its way higher. And then we have this, you can see it here, this candle here, the red one, pushes through it almost becomes engulfing, but it pushes through more than 50%. So that is dark cloud cover, for example, okay, where the market, we've seen the market reverse during the day. I can't see any sort of good engulfing-y type candles here, but let's have a flip over to Euro Sterling. Let's look at something that maybe it's a little bit more volatile. Here we go. Let's get Euro Dollar. Sorry, Euro Dollar. So let's have a look. What have we got? What have we got? I think the problem is because in FX you get the moves. You can often get pretty sharp reversals. We don't really have any that pretty textbook ones. But for example, let's have a look back here and let's have a look. So the market had been trending higher from March into end of March. So it makes fresh highs, at least 1 month, 3 month, 4 month highs, whatever that is. Then we have a day. This is the engulfing. We had a really small range on that day anyway, but hopefully there you can see the engulfing pattern. Yeah, bearish engulfing reverses, covers the body of the previous candle. The aggressive trade would be to go short, stops above the highs. That would be the aggressive trade. Let's see. So we have like this is a bullish engulfing, but it was such a tiny day the day before that I'm reluctant to use it as that good an example. There's maybe a better example here, going back into May of this year. Market sells off what, a week and a half, looks weak, and then we have a day that does this, that engulfs pretty much, or maybe it's not quite engulfing, but engulfs pretty much the previous day's candle. So again, the aggressive trade, be a buyer, stop underneath the low. And if we go to where we are now, just to prove it doesn't work all the time, here's an example that didn't work. So the market sold off really heavily for 3 days, 4 days. Then we get a day that does this, bang. So that's, again, not quite engulfing, maybe a big piercing pattern. The market rallies for a couple of days and then flops. And we've not really had anything else since then. Let's have a look at pound US dollar. Then we'll look at some other markets. So pound US dollar. Oh, again, not really much here, actually. Okay, up here on the highs. So market is rallying, gets up to a level, 2nd of August, all looks very strong, and we have a big day that reverses and more the previous day. So this was a pretty big bearish engulfing candle. Okay, so that's what they look like. If I spot any more while we're going through today, I'll flag them up. But there's a couple of not fantastic examples, but okay examples. Let's take a look at stock markets. We did see yesterday, I think, yeah, let's start off with the S&P. Okay, the range, I mean, let's not forget, it's a market, first of all, that is still incredibly strong. You know, it's almost a year ago now where we had the US election, or 11 months ago, where the S&P was at, what was it at before the election? About 2100-ish, give or take. And we're now at 2550-ish, give or take. So the market's rallied 400 points. So it's more than 20% rally since the US election last year. So let's not, you know, kid ourselves which way the trend is on this market. You know, it's clearly up. And we do get tiny sell-offs, but they don't seem to last very long. Okay, so that's where we are, and you can see just how tight. Look at that range over the last 5 days. It's like non-existent, that range. You can hardly even see it there on the chart. So let's just flip over to the hourlies. I thought what was interesting was it yesterday? It was yesterday. The market yesterday, the S&P 500, did push out to fresh all-time highs in the first hour. So you can see it there. It hit fresh all-time highs back here, October the 5th. It's been bumbling along for a couple of days, and yesterday it spiked out to fresh all-time highs again. But we didn't have the follow-through, which is interesting from a nerdy charty point of view, because in the past, whenever we've seen it move out to fresh all-time highs, there's almost been a scramble to get on board. Yeah, so but yesterday we rejected those highs really quickly. If we see it on the 10-minute chart, there we go, it's a bit more dramatic on the 10-minute chart. So there's the push out to the highs, kicking off a load of stops of people who were short, and the market just dumped. So that's probably the most bearish thing we've seen for about a couple of weeks, and it was all over in about 15 minutes. So you could argue, if you were absolutely convinced the US stock market is going to crash from here, if you're going short, you've got a logical point to put your stop, up above yesterday's highs. But I dread to think how much money has been lost in the last year trying to go short the US stock market, because it just continues to defy gravity. So let's take a look on the hourlies. What we're looking at on the hourlies. Let's have a look. So there we go. So we've got our trend. It really has taken off again since the end of September. The S&P 500. We had quite a bit of sideways stuff going on the second half of September, and then it's taken off from about the 25th of September. So this is where we are. It's very difficult to say you'd be anything but a buyer on weakness for the S&P. We've got various little pockets of support left, sort of 25.40-ish through to 25.45, bigger levels out at 25.30. But because we've had sharp moves off and these tiny diddly little sell-offs and a sharp move off, we have lots of little pockets of support. I do think that if we did get a half decent move down on US stock markets, it could kick off quite a bit of panic selling, with people who have been maybe lulled into a false sense of security that the US stock market just goes up forever. I think if we did see a half decent sell-off, whatever that is, I don't know what it is, 70 points on the S&P, so that's only 3%, but a 3% drop in US stock markets, we could see it could kick off a bit of a panic, but there's no signs of that happening. Famous last words. I think I retweeted something last week that this has been the lowest drawdown year in the S&P. I don't know if it's forever, but for an awfully long time. So what it means is, in terms of giving up profits along the way, markets might go up 15%, drop back 7%, go up 10%, drop back 8%. But it's those drops are the lowest that we've seen in many, many years, if not forever. Okay, and it just points to, I think the lack of volatility that we've seen in US stock markets. Of course, if you've got your entire pension invested in the US stock market, you're having a cracking year. You're 20% richer than you were a year ago. But I think from a trading point of view, it does make it difficult. So because there's just not the volatility. So I think obvious first level to watch, 25.40. Maybe tonight in the minutes from the Fed, we'll have a bit of drama, but lots and lots of pockets of support. And I would be a buyer all the way down, almost, on the S&P. I think it's only if we start to lose these lows, and they were only lows from 2 weeks ago. To put it into perspective, it's 60 points away from where we are now. So what's that, 2.5%? But it was only a couple of weeks ago, because the market's rocketed up again. I think it's only started to push through here that it looks even minorly bearish, but just an incredibly strong market. Which is just a little bit boring. If we look on the Dow, we're going to see a similar sort of thing, of course. Just take a look at the Dow. Here we go. So the Dow again, this is the hourly on the Dow. Again, nudged out to a fresh all-time high yesterday. Or actually, in the early hours this morning, it looks like it's done it as well. That was yesterday's bang bang, and it's nudged out a bit higher, but come off. Dow, 22,700, the lows from the last couple of days or so. But then we've got lows at 22,600, lows at 22,575, so it goes on. So US markets not very volatile, but still grinding their way higher. Let's bring things a bit closer to home. Let's take a look at the FTSE and the DAX, and then we'll have a look at some of the commodity markets. So here we go. There's our FTSE. Let's go back to daily. Let's just put it into some perspective. Here we go. It's interesting up here, the FTSE. The trend clearly, all markets are being dragged up by what's going on in the US. So there's our FTSE going back. There's the old Brexit shenanigans last year, but we are not far off the all-time high on the FTSE that we saw, let's say 7,600, for the sake of argument, that we saw set earlier this year. So I think again that's interesting. If you want to be a contrarian and take the view, well, this market has gone far enough. There's an obvious level to take a stop. The market's 75.19 to sell. We know the all-time high is just shy of 7,600. So if you put your stop at, I don't know, 76.30, so you've got a 110-point stop. And if you think the market is going to go all the way back to only the September lows, you've got 400 points upside. if the market did slide off down here. So I think it's interesting. You know, we're back into an area for the FTSE that since June this year, the market hasn't been able to hold on to. So interesting. Up here you can see, look, bang, there's a bearish engulfing there. So the market goes up, bearish engulfing doodah, bearish engulfing up here, and that one there, August, so the market's going up, 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 and we have a day that engulfs the previous days. So, I mean, today we'd need it to close below 74.92. Well, it's only 30 points away from where we are now, and we'd have another bearish engulfing set up there. So, let's see, big level to watch on the FTSE, but, you know, if we saw US stock markets push out yet again to fresh all-time highs, I would expect the FTSE to get dragged through as well, get dragged through 7,600. So I think it's maybe a bit more of a more interesting market to keep an eye on in the next few days. I do wish, and I think plenty of people do, that we would have a bit of a sell-off in US stock markets, because it would make it, it's not good for our pensions and stuff, but it would make it a bit more interesting than it is at the moment, because it is just a little, it is a bit like watching paint dry at the moment, US stock markets. And here's the DAX. So this great recovery in the German stock market. So we had that big sell-off. So when other markets were sort of pushing higher throughout the summer, the DAX was doing its own thing. So it came off from just shy of 13,000, sold off as low as 11.8. So you know, that's a sizable, almost a 10% decline that we had in the DAX through to the end of August. And look at the bounce back. Again, like the FTSE, okay, we've seen a break. The question is it a false break? So we have seen it nudge out to fresh all-time highs. But does it end up being a false break? And again, in the aggressive trade up here, if you thought these markets are getting a bit overcooked, the aggressive trade is to be a seller, 12,930-ish, with stops above those highs, up above 13,000. To add weight to your bearish argument, ignoring the fact that all these trends are up, which I think is the most important thing, the doodahs, the MACDs, are crossing over just today. If the market closes here or hereabouts, we'll have the sell signal off the MACDs. So it'll be interesting. Be interesting to see what happens. You know, maybe again, hopefully with the US, the minutes tonight from the Fed, maybe we'll have a bit more volatility off the back of that and make stock markets a bit more interesting. But again, you know, incredibly strong, as we know. You know, we've seen it week in and week out for nearly 12 months now. Let's take a look at the commodities to start wrapping things up. For me, the interesting market to watch is still euro-dollar, I think, because of how maybe, you know, it's been beaten up from those highs and it looks to have turned around in the last couple of weeks. And in the light of the minutes tonight, I think we could see a lot of volatility. But let's have a look at the oil market first of all. Here we go. So oil is, I think, just picking up on what we were talking about last week. You know, we had oil started this year or ended last year really positive after getting knocked back to $26 a barrel. You know, it was up in the mid-50s by the end of last year, and I thought, well, this year we're going to see it push higher, we're going to see 60 tested, blah, blah, blah. But actually all we've seen this year is this gradual decline in the price of oil. So it's gone from, if I could draw it, those highs, and depending on where you draw it, looks, I don't know, it looks something like that, maybe. Oh, let's plonk it up there to be accurate. There we go. So I think as we picked up last week or so, it's the first time we've seen that trend in oil, that downtrend in oil, breached this year. You know, we've seen rallies, but they've never got as far as taking out, and this one was looking like it was going to do the same thing and just dump lower. Never got as far as taking out the previous major high. But all this has changed. You know, in the last couple of weeks or so, you know, we've seen oil push out through 50, have a little look above 52. So it does suggest, I think, that the bias for this year has shifted from one of selling rallies to rather sort of buying the dips, you know, and that's borne out by that trend that's been in place now since June. So for me, that's the dominant trend. You know, the rally from June, we're still in that trend. So I don't know, medium term, you know, a push back up to the mid-50s. We're currently trading at 51 now. You know, plenty of volatility along the way. You know, obvious levels to watch for short-term traders. The lows, $49, so a couple of dollars below where we are now. Bigger levels out at 47. Let's have a look on the hourlies. Clearly, I mean, it is oil is a really volatile market, and you need to give the thing, time to move around. I think if you're trying to trade it with really tight stops, I think you're just going to find it frustrating. I mean, look at this day here. This was a quiet day, and the market went from 49.77 to 50. So even on 50.65. So even on a day that was dead, the market moves 100 points. So if you're trying to trade oil with a 12-point stop loss, good luck. Good luck with that one. Because I think you do need to give it room to move around. This afternoon, and this would have been really frustrating. This false break, these old lows, market breaks, and then no follow through, and has rallied back up. So there's our 49 level. This afternoon we have the oil inventories. So that's the US announcement on how much they've got oil stockpiled. So we can often see volatility off the back of that. I think it's 3:30ish this afternoon. So we can see a bit of volatility off the back of that. But on this chart, on the hourlies, if we do get it back in the mid 49s, I think it looks interesting down there. Stops somewhere down here, somewhere. But going back to that daily, I think it does. It continues to build the case that we've shaken off the worst of the weakness this year. Famous last words. And the last one is gold. Let's take a look at this. This is always interesting. I've been waiting for this. You could argue it's still not happened properly, but just to remind ourselves, the trend for this year in gold is still up. It pushed out to up at 1360. So it's best levels for a while. Let's just flip this out. There we go. So there's the 13. So best levels since virtually a year ago, give or take. So let's go back to the dailies. So I think for gold, for me, it's been all about, well, when is that correction going to end? The one we've been in off those 1360 highs. So if we plonked our trend, something like that. So it's all about this. Has this ended? And I think we were looking at it a couple of weeks ago and saying, don't get sucked in. Just because we had a big day, don't get sucked in. And the market has pushed lower. Let's take a look at the hourlies and see what that looks like. There we go. So there's our big sell-off from those highs in gold. So let's plonk it on and see how that looks. There we go. So actually, you could argue, a bit like the pound against the dollar, the moves we've seen over the last couple of days, we're finally shaking that off. We're finally shaking off that downtrend. So again, there's an aggressive trade. There's an aggressive trade if you think the market's going to swing all the way up to 1360 again. Is a buyer here and a stop under the lows from last week, or maybe the more patient trade, wait and see if the market sells off, see some strength come in and buy it there, so you can have the stop loss not so far away. So I think it's an interesting one. Maybe now that slide that's been in place for almost a month on the price of gold is coming to an end. Okay, we're going to start wrapping it up, but I think the interesting market for me, euro dollar, I think, in terms of trading opportunities, because maybe it's turned it around this week. Also, but not as urgent, pound against the dollar, because it had its worst week all year last week. It has turned it around a bit this week, but really still needs to break 133. And stock markets as ever, particularly maybe the FTSE, because on the dailies we're back up at levels. My charts have all gone a bit skew with here. I think we're back up at levels that proved to be a problem a few months ago. So are we going to see the FTSE struggle again with this 7,600 mark? Let's see. Let's see what it brings. But for this week, we'll wrap things up. We'll do it all again next Wednesday. So it's the Fed later on today. So a quiet afternoon probably, and then a bit more volatility. I can't even say it. I'm not even bother. After that, if you've got any questions, drop me an email. Email address is david@tradeafter.com. I did blog about some social trading, copy trading. So if you go to my website, tradeafter.com, you can read it there, and you can follow me on Twitter for updates, which I haven't been very good at doing, but I will start again. And it's @JonesTheMarkets. But we'll wrap things up there. Thanks for coming along, and do it all again next week. So I hope you have a good week.